The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Sally Bakewell. We're kicking you off to the closing bell here in the U.S.
Let's get a check on these markets, where we stand on this Monday with just an hour to go. You can see the S&P 500 giving up its earlier gains, now dipping into the red there on the big benchmark. Tech trying to hold on. The NASDAQ 100 higher by about 0.4%. We were certainly higher a few hours ago. Meanwhile, you take a look at Brent trying to decide what to do. Currently higher by about 1.5% here, trading just below $90 a barrel as we parse through reports about a potential truce, but at the same time weigh the impacts of a Houthi ban on Saudi ships. And did want to highlight that we are seeing a sell-off when it comes to the bond market. 10-year yields higher by about 5 basis points. A quick check under the hood to see where all the action is on the single stock level. A lot of eyeballs on Google today, higher by about 1.5%, gaining on a report that they're looking to develop their own server chip to optimize their Gemini AI model, certainly giving a little bit of a boost to Alphabet shares ahead of earnings this week. Warner Brothers Discovery also in the zeitgeist today, a judge pausing the deal between Paramount and Warner Brothers, citing serious concerns. And Chipotle, we're going to keep an eye on that this week, down 4% at the moment as we continue to track the fallout from Cyclospora. Meanwhile, I did want to bring our attention to a really interesting chart. I think it's a real sign of the time here. We're taking a look at free cash flow between hyperscalers and what we're seeing when it comes to semiconductors. In blue there, you have the 12-month forward free cash flow estimates for semiconductors, and then in yellow, that is the same figure for hyperscalers. And what an interesting handoff. Really tells you where the money is moving. We know that hyperscalers spending big on AI ambitions. Semiconductors have been the benefit of that as measured by free cash flow. And that's where I want to start with Matt Rowe. He is Senior Portfolio Manager over at Man Group, joining us on set. Matt, it's great to see you.
Great to see you. Thanks for having me.
So that is one of the big questions once again as we head into this earnings season. We got the start of the tech giants reporting this week. And the question once again is, are they going to be able to justify their AI spending? When you take a look at the setup in markets at this moment, how are we priced?
I mean, we're pretty much back to being priced for perfection from an actual fundamental perspective, but also from a forward execution perspective. There's really a lot of immunity being baked in to higher base rates, higher commodity prices. People tend to forget that a lot of this narrative does use a lot of energy. And with higher cost prices or with higher prices in general, it pushes off profitability, but profitability isn't really what people are looking for in this part of the market right now.
And it's interesting, you know, some of the notes you sent over to our producers highlighting that when you take a look at volatility, it seems to be basically defying seasonality as measured by the VIX, which is particularly interesting at this moment in time because it's not just tech earnings. We also have what some people would still argue is a live Fed meeting coming up in the next week or so. Yeah,
trying to figure out what they're focused on, what the measures are that they're going to be zooming in on, the research project around new indicators, new ways of transmitting information and receiving information. There are a lot of questions out there about the way that things are going to work with the Fed going forward. So I would say it's a live meeting, especially like even at a very base level. People are pricing in a possibility that we get higher rates, you know, in a couple of weeks. So remains to be seen.
Stocks are up today from strength in chip makers, but amid the constant volatility, how are you helping clients strike that balance between participating in the tech-driven momentum and the rally while staying disciplined and avoiding over-concentration risk?
Yeah, that's a really challenging part of managing portfolios right now, because you look at the VIX right now, and at 18, that's kind of on the high side of normal. I would say that there is no concern really priced in. And what we refer to as dispersion, or the movement of the underlying components of the index, has been very high. Correlation's been low. So that means that there isn't much concern baked into the market. There's a lot of movement of the idiosyncratic names, but a lot of the upward move has been driven by a very narrow subset of the market. So investors are really painted into a corner. They feel that they may be overexposed to the category, but they feel like they need every bit of it to keep pace. So it's a quietly challenging environment for investors, and I think the main thing that we're doing to help investors is to don't make some line in the sand decision and saying this is as far as it's gone, we're going to deallocate. Don't do anything dramatic, but be diligent, be diversified, be focused on maintaining control of your risk, because in a market like this, as some names are really ripping higher, you can end up with concentrated risk just even by accident as things expand.
And as we see the earnings this week, and of course the dominating narrative is whether their massive capex is justified.
Yeah.
Now, what kind of line items will you be looking at in their earnings to find whether they've been successful in monetizing that?
Well, that's another tricky part of the story, because the expectations aren't necessarily that this massive amount of investment is going to be translating into profitability or into, to gross revenues. There are a lot of different measures of just uptake and utilization, but I will say that a lot of the users of the AI narrative of the products are becoming increasingly sensitive to the cost, because a lot of companies at the beginning of the year cut people loose to see what they could do with AI in general, and they're seeing that it's not free. So there is some price sensitivity from the users of these products. We are starting to see some competition. I can't help but draw an analogy to the telecom build out of the late 90s. The people have said repeatedly that the worst version of AI that we will ever use is the one we're using today. Mm-hmm. And I think that's very true. I think things are getting competitive, they're getting faster, they're getting cheaper, they're getting more efficient. And if you believe in Moore's law, things will continue down that path very, very quickly.
Yeah, and it's interesting, I've heard that parallel drawn time and again to the telecom build out, and it creates this sort of specter. What if we are in the midst of a massive build out? And I mean, it's scary when you think about the potential daisy chain there, if that ends up being the case, because it feels like that AI trade, that build out has spread through so many different industries. I mean, if we get some sort of hint from these hyperscalers, from the big tech giants on deck in the days ahead, that maybe they're pulling back or rethinking their CapEx plans, I mean, what are the potential ripple effects there?
I think we're starting to see it already. You see it with debt issuance, right? I'll stay away from mentioning single capital structures by name, but everybody wants to be long the rocket launch of an equity offering, and people are very reluctant to be more at risk to the long-term execution, which you can see sometimes priced in 5 to 30-year debt, right? So the appetite for the risk on the front end is almost insatiable, but it's coming and going relatively quickly. So I think the ripple effects, again, coming back to this analogy, and I and other market participants who feel like we've seen this sort of story before, kind of feel like we're doomed to repeat it a little bit, and that can be a good thing, it can be a bad thing, depends on how you're positioned, but we're going to see winners, we're going to see losers, we're going to see acquisitions, we're going to see failures, and it's impossible to know in baseball terms what inning we're in, but if you ask me, I think we're probably in the 7th inning stretch of trying to see where things are going to go.
I mean, you mentioned debt issuance here. I mean, at what point does this spend risk and this massive corporate debt burden that some of them are building up, at what point does it become a kind of corporate debt drag or a margin drag? Yeah,
I mean, I think we will see companies like this shift to more dilutive transactions at some point as well. But I think, for now, even though in dollar terms it's been relatively high for the market broadly, as a function of their market capitalization, it's still not alarmingly high. So from a debt to equity perspective in the category, they're not wildly levered yet. So I think we're going to continue to see issuance. I think investors will continue to price it, but a number of these very large companies that should be issuing paper at roughly IG levels are looking more like borderline high yield from a spread perspective. So the investor response to that is a little bit more concerning about what are they going to do with the money and will we be compensated for it.
Absolutely. It's going to be fascinating to watch what sort of demand those debt issuances attract. Also what sort of premium is demanded there as well. Matt, great to kick off the show with you. That is Matt Rowe. He is a senior portfolio manager over at Man Group. And coming up, a big week for tech results. Steve Wesley, he is a former Tesla board member. He joins the program ahead of the EV makers' earnings. Plus, the major winners emerging off the pitch as Spain is crowned World Cup champions. We'll break down the numbers with Visa CMO Frank Cooper. And Christopher Nolan's The Odyssey posting an epic debut. IMAX CEO Richard Gelfond here to discuss the film's blockbuster performance. All that and more coming up. This is The Close on Bloomberg. Well, a new week bringing fresh AI jitters to the fore as Chinese startup Moonshot jolts the market with a surprise release. The company unveiling a new version of its Kimi model, saying it rivals the best offerings from OpenAI and Anthropic at a much lower cost. Let's discuss with Jessica Inskip. She is Director of Investor Research over at stockbrokers.com. And Jessica, it's the obvious question, the obvious comparison. You think about when DeepSeek came on in the scene January 2025, I believe. I mean, the reaction was swift and brutal, especially when it came to stocks such as NVIDIA. So you think about what we're seeing right now with Moonshot, with Kimi. Is this basically a mini DeepSeek, a DeepSeek 2.0?
It is in the instance that it's overblown. We saw that with DeepSeek, where the fear was Capex spending would pull back. They only accelerated and continued to, especially from the free cash flow chart we were showing before I came on. So I do think that any advancement within artificial intelligence increases efficiency, and there are a lot of bottlenecks. We have a lot of players in the space, then that means we can start being more efficient with those bottlenecks. The bottleneck that still remains is the high bandwidth memory.
Right.
And that's why we're seeing the rallying within that space, but also interestingly enough, photonics and that sector as well. So I think there's lots of room for improvement, but what's interesting with what's happening over here in China is it's their bottleneck. So it's now software where they can utilize on almost any chip that they have, whereas where we're focusing on efficiency here in the States with Frozen coming from Google and that experimental model, also Jalapeno from OpenAI.
Right.
Very, very,
yeah.
to share.
It's interesting when it comes to Google. You mentioned Frozen, and it seems like at this point, every major AI developer is working on their own chip in some sort of way. And I guess that's simply, a sign of the times when, again, you think about what we're sort of dealing with in the U.S. specific market here.
Yeah, they are dealing with their own chips, but they're all marching towards the same solution. And that's where I think we can find the opportunities. We spot the bottlenecks, we spot the opportunities from there. So we're in the year of agentic AI. We were in agentic AI last year. Now we're really utilizing that with agents taking off. With agentic AI comes inference. Inference comes with a continuous cost. That continuous cost requires a lot of memory. But the solution is we need to reduce that load or that talking to time. It's doing a math equation, but it's waiting in line at a cafeteria, basically, waiting to get to it. So we need to speed that up, and that happens with more efficiencies and out-of-the-box thinking, and that's what I think Google is doing. So it is a big play because they have huge backlogs that they're turning away from their cloud. So it's something that they, I suppose, are willing to do, but it's a big bet that this is the end-all architecture. And I think that's what's interesting, and that's why they're calling it experimental, if you will. Because if we're putting a model directly on a chip, it's only specific to Gemini, whereas Jalapeno could theoretically be utilized on any other type of model, and that increases the efficiency on inference specifically, but that's only available for mass scale. If you're an individual utilizing that, doesn't make any sense.
Speaking about Moonshot, now if Chinese models like that, if they require dramatically less resources than Wall Street necessarily expected, does this to a degree invalidate the aggressive Capex timelines that are planned by some US hyperscalers, and could they indeed feel the pressure to reduce that?
I hope that they don't reduce that, because if we look at going back to the dot-com bubble, the first thing that peaked was the GDI spend. So I do want to watch that. That was 3 years prior. So it's just something to be cognizant of. But it is possible that it shifts. I think we need to remember that corporate America is very agile, especially these tech companies. We see Meta has pivoted multiple times, and I would expect to see that pivot as well. So I do not expect to see a pullback on CapEx. It would just be a redeployment of funds. And what's interesting is I even see this inference spend as more of an OpEx spend, a continuation of operations rather than building out. But it is something to watch, because then that can give us an idea of the return on investment. And that's why earnings are going to be extremely important for Google this week.
For sure. And then one extra question here, under the US semiconductor export controls, is it possible for models like Moonshot to truly reach scale?
It certainly is possible. I think that's the point of it, is that it could utilize whatever it needs outside of those controls. And that's why it's so innovative. But it's very different in comparison to Jalapeno and to Frozen. It's very funny to say these names out loud. It's software versus hardware. So they are two very different things. So I think it's designed to go outside of that, if you will. But it's all a bull case for memory, but there's still going to be a shift at some point.
Yeah, my mind keeps going to Elsa, but no, we are talking, of course, about Google's chip. Jessica, great to get some time with you. Really appreciate the context there. That is Jessica Inskip. She is Director of Investor Research over at stockbrokers.com. Now, coming up, all eyes on Alphabet ahead of its earnings report on Wednesday. We're going to preview what to expect after the break. This is The Close on Bloomberg. Well, it's time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And first up, Urban Outfitters. Goldman Sachs upgrading shares to buy from neutral, saying that Urban Outfitters' brand recovery can bolster the company's profitability. Goldman upgrading the price target on the stock to $93, citing, quote, emergent growth drivers are also scaling, led by free people movement and Newly. I hope I said that right. Shares higher by about 3.5%. Next in line, we have U.S. Bank. Analysts over at Evercore upgrading the bank to outperform from inline thanks to a robust outlook and improving fundamentals. Evercore also raising its price target on the stock to $72 from $65, saying that those improving fundamentals will enhance the bank's earnings trajectory. Shares just about unchanged. And finally, HubSpot. Wells Fargo cutting its recommendation on the software company to equal weight from overweight, flagging near-term AI concerns. The firm also lowering its price target to $225, citing the company's strategic initiatives will introduce uncertainty for investors who would like improving results in the near term. Shares shaking it off higher by about 3%, and those are some of our top calls. Now let's stay in the tech space, because shares of Alphabet on the rise today on a report that the company is developing its own custom chip to optimize its AI model, Gemini. This comes ahead of Alphabet's earnings, which are due after the bell on Wednesday. Joining us now is Brent Thill. He is tech sector leader of software and internet research over at Jefferies. Brent, great to have you with us. So we'll get into the broader earnings outlook, but first I do want to hear your thoughts on that report that basically you have Alphabet trying to develop a server chip designed to optimize Gemini here, called Frozen. It could be deployed as soon as 2028. What do you make of this and this effort?
I think it's what you would expect from Google. They effectively have a vertically integrated model. So the interface that you and I can interface on AI with Gemini, to search, to cloud, all the way through to the media assets. You look at the foundational side of the chips. They built their own cooling racks. They're, I think one of the best vertically integrated AI plays that we cover, because they're building all the components. It's like having this amazing home, but you got to go to the grocery store to get milk and whatever you want to eat. They effectively can open their back doors, and they have all these assets that they can utilize for cooling chips, the data, the users available right in their own backyard. So they own the biggest estate in AI. They have the data, and having all these components just gives them a continued advantage in the AI world. So they're in a great spot. Others like Microsoft obviously have to leverage others in the industry to buy their food from for AI, if you will. So this analogy of they own the biggest AI ranch, and they have the cattle, the sheep, the flowers, they got everything built in, which is kind of what you want as an investor. And can they do this cheaper? The question is, can they do it as well, and can they do it cheaper? Is the question. And so far, I mean, they're growing high teens with a 40% operating margin. They're close to a rule of 60 company.
Right.
I mean, it's pretty amazing what they're doing.
So they've got all the things that a rancher and an investor would want when it comes to Alphabet's business here. And you take a look at the shares, I mean, they're higher by about 12.5% on a total return basis year to date, outperforming the broader S&P 500. The bear case, or one of them, would be that you think about their core search advertising business. The fear is that maybe that could moderate a little bit as maybe Anthropic and OpenAI gain some market share. How are you factoring that in to your analysis? And I'll note, of course, that you have a buy rating when it comes to Alphabet.
There's room for three big vendors, and we think it's going to be Google, OpenAI, and Anthropic. And then you have obviously the world of open source models that will thrive. So the symphony, if you will, of multiple band members, if you know, in that from multiple AI companies, we think Google is one of the top frontier companies. So every market has a leader, a challenger, and a follower, and we believe that that they're in a really good spot from that perspective.
Frozen V2 is designed to optimize Gemini's efficiency, and with Capex under the microscope now so much, how much could this address and compress Alphabet's long-term Capex?
It's unclear. We don't really know, and we don't know all the capabilities of this. But I think that, you know, to your point, the Capex has been the biggest issue, and Capex continues to go higher. We don't see any reason why Capex isn't going higher. The magnitude and the rate of change as we go into next year, we think will compress. So we'll see 70, 80% Capex growth this year. We believe it'll go to 50%. So absolute Capex goes higher for the industry, but the actual growth, we think, will start to subside in terms of the growth rates that we've been seeing the last couple of years. In terms of, you know, what these individual systems will do to Capex, it's really hard to say. But right now, when you have a lead, and we know that enterprise AI is in literally, like, we're in the first 5% of enterprise AI,
right,
and we're maybe in the first 10 to 15% of consumer AI. No one's taking their foot off the gas in Capex. So I don't think, you know, don't brace yourself for a massive change in downgrade in Capex. We think it grows, but the actual growth rate will start to slow as we go into 27.
All right, that's a good place to leave it, Brent. Great to preview some of the action with you. That is Brent Thill. He is tech sector leader of software and internet research over at Jefferies. Now, coming up, Tesla getting ready to report earnings on Wednesday, and business is a tale of three cities, according to former Tesla board member Steve Wesley. He joins us next. This is The Close on Bloomberg. Just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Sally Bakewell.
And of course, we're keeping our eyes on a very big earnings week ahead. When you think about the calendar, Sally Bakewell, and all the different heavy hitters we have coming up.
Yep, we sure do. We have Alphabet, we have Intel, and I think strong results from Alphabet, from its Google Cloud business, and Intel's data center and chip-making units will really reinforce this view that hyperscalers and hardware makers are kind of capturing that discretionary software spending, which there's been a lot of scrutiny over.
Yeah, absolutely, and we saw that story really taking a bite out of IBM, which does report on Wednesday this week as well. But let's talk about that big red icon there, reporting Wednesday, Tesla. Of course, taking the stage after they delivered second quarter vehicle deliveries. Joining us to discuss is former Tesla board member Steve Wesley. He is founder and managing partner of the Wesley Group. Steve, great to have you with us. As I mentioned, you think about the second quarter vehicle deliveries, they beat expectations. They went over pretty smoothly there, but you say that Tesla right now, it's a company that's a tale of three different cities. Enumerate them for us.
You bet. Well, look, give credit to Tesla for a strong quarter, the fourth highest revenue quarter in their history, sold 480,000 units, 25% year-over-year growth. Take a bow. But sales appear to be rising on high gas prices, and total revenue for the year still looks to be about $95 billion. That could be the fourth consecutive year of flat growth. So the big issue here is they're still forecasting flat year-over-year revenue. What's going to happen? And I think it's really, again, this tale of three cities. Auto sales are up, riding a wave of increased gas prices. Second, everybody's waiting for this new tech to finally become real. Can they get more full self-driving licenses? Can the Optimus get into market sooner? They're a little late on that. personally, I think the big bet and what investors should be watching is their energy division is taking off. 2026 revenue going to be up about 35% to 16 billion. But if you're tracking their building plans, they're about to launch the next new facility, 50 gigawatts in Texas. This could make Tesla an enormous auto and energy company at precisely the time the world is clamoring for more energy to power the world's data centers and the AI revolution. If they do that, expect prices to go up.
I'm glad you brought up the energy division because for a while it felt like it was the best kept secret when it comes to Tesla. And I wonder though, Steve, is that still the case? Do you think that, the energy division and the potential runway there, do you think that's showing up in the valuations, in the share performance?
So I don't think people really have their arms around that. They think about car companies over here and then the big energy companies like Vistra and Nextera over here. By the way, Vistra, the third largest appreciating stock in the world last year after NVIDIA. So people are kind of getting that, but they're not realizing that Tesla has quietly become a major battery production company. They've got a huge facility in Lathrop, California, one in Shanghai, but they're about to put this new one online in Texas. 50 gigawatts is an enormous number. And the reason that's so key is with the explosion in data centers to power this AI revolution, every utility executive in the country is looking for new sources of power. If Tesla can be one of those leaders providing not just gigapacks, these are 1 to 2 megawatt boxes, but if they can provide full energy walls that can provide as much as a gigawatt of power, that's going to put Tesla front and center. That's going to lift their share price. And that's what the world wants right now. So stay tuned. Tesla may be more than the auto company we thought.
Okay, Steve, so when it comes to robo-taxi and bringing Optimus to the market, do you think Tesla is successfully going to do those things? Because also some investors certainly feel like Optimus is a bit of a hall of mirrors.
Well, here's the tough thing. Tesla's continued to improve their full self-driving. Anybody who has one can see it's doing better and better. But at the end of the day, you've got to monetize this. You've got to show that robo-taxis are real. And to do that, you need regulatory approval. And that means passing rigorous tests, moving from a level 2 to level 3. You've got to be level 4 to get regulatory approval. This is why Waymo is way ahead. Tesla regulatory approval in only 2 cities, San Francisco and Austin. Waymo already approved in 11 cities all over the country, about to open up Tokyo, London, going international, saying they'll be at 24 cities by the end of the year. Tesla has got to close some of that gap. The other key piece here that investors need to be watching is, can Tesla get approval for freeway driving? Because once you get freeway driving, you can open up areas like San Francisco to not just downtown San Francisco, which is 800,000 people, but the entire Bay Area, roughly 3 million people that the Waymo serves today. So they've got their work cut out for them. I hope they can do it.
When it comes to closing other gaps, so can Tesla regain the top spot from BYD?
So that's the big question. And right now, I think that's a longer shot. Now, BYD has a different strategy. They're not talking about being a technology company. They're not talking about being an energy company. They're just saying, they are an energy company because they're one of the world's premier battery providers. But what they're doing is they're saying, we're going to own the low end of the market. They're making an absolutely tremendous $19,000 BYD Dolphin or Seagull, depending on what part of the world it's being sold. They're absolutely dominating the Chinese market. Why is that so key? China, the largest auto market in the world, 1.8 times the size, almost 2x the size of the US market. But they're really tackling now Europe and rest of world. They've put factories in place in Cambodia, Indonesia, Thailand, Brazil, Turkey, now Hungary. They've got a global production network. And BYD came out just this last week and said, we're not just going to be the leading EV company. By 2030, we plan to make more cars than Toyota. If they do that, it's hard to say who's going to catch them. They appear to be in the pole position.
Absolutely. Certainly a lofty goal there. It's going to be fascinating to see whether or not they do cinch that. But Steve, I do want to get your perspective on the Elon Musk of it all, because you think about Tesla, you think about now the addition of SpaceX into the public markets. It's talked about almost as a given that we're going to see some sort of merger there, that we're going to see SpaceX absorb Tesla. And I wonder, in your view, in your experience working with the company and with Elon Musk, I mean, is that an inevitability to you as well?
Well, look, as a betting person, I think it's pretty likely to happen, but that's up to the Tesla and the SpaceX boards. I think the thinking would be, gee whiz, it's going to be easier to have reins over one company. It would be easier to manage. There's probably an awful lot of synergies. You could use some of Tesla's profitability to help build out SpaceX. But as a betting person, I have a hunch it's likely to happen, but we'll see. There'd certainly be a lot of regulatory issues to get over, and it would certainly make one heck of a large company to compete against.
Absolutely. Well, Steve, always great to get some time with you. Appreciate your perspective. That is former Tesla board member Steve Wesley, founder and managing partner of the Wesley Group. Now, coming up, the blockbuster deal of the moment hitting a major snag. We'll unpack the latest developments with Warner Brothers and Paramount in today's Stock of the Hour. Up next. This is The Close on Bloomberg. Well, our Stock of the Hour today is a twofer. Paramount, Skydance, and Warner Brothers. Shares of Warner Brothers lower rate now. Paramount also wavering after their blockbuster deal was halted by a federal judge. Joining us live with more is Bloomberg's Chris Palmieri, joining us on set in New York, which is a rare treat. And Chris, thank goodness you're here, because I need some context.
Yes.
Was this expected in any sort of way, and what's the next step here for this?
In a way, but to put this in perspective, Paramount was very close to closing this deal. I mean, they already got DOJ approval. They were expecting on Wednesday for the regulators at the EU to approve with just some minor concessions. And so then, boom, we have this lawsuit, 12 states attorneys general suing, and now we got a halt to it. So obviously not going to close this week. August 3rd, there's going to be another hearing, could be an extended injunction, so they couldn't close until after a court, ruling, a decision in that case. The states are asking for, a hearing next year. Okay, so big penalties for Paramount if they don't close by the end of September. Millions of dollars a day in fees paid to Warner Brothers shareholders. And if this whole thing falls apart, a $7 billion breakup fee. So a lot at stake for Paramount.
Yikes, that sounds very, very painful. I mean, is there one particular sticking point here? And is there a potential to address it, or for the deal to be revised or restructured in a way that would make it more palatable to those who
I think when you looked at the stocks market's reaction, both when the suit was filed and to today's news, I mean, it's not a complete collapse. And I think investors believe there's some way out for Paramount here. I think there's a potential for some settlement with the attorneys general. Now, they've said they don't want just some sort of remedy that sort of agree to do something. Paramount suggested, we're going to release 30 movies a year in theaters, that kind of thing. They've talked about some actual sort of divestitures of properties. So whether they hash out the deal remains to be seen. It's certainly possible, because a lot of people say this isn't the strongest case that the attorneys general have brought. So maybe there's a face-saving way for them to come out of that.
Mm-hmm. And I mean, you just reflect on sort of the road that this deal has taken. As you said, they were very, very close to closing here. It looks like that's going to be delayed, certainly not happening this week. And then you think about what it took for Paramount to even reach this deal. I mean, they were neck and neck with Netflix for months here, it feels like.
I mean, it's been brutal for a few years for David Ellison, the Paramount CEO. I mean, first of all, getting the Paramount deal done, years, and merging Skydance with Paramount, and now this fight, which he initially lost, as he said, to Netflix, paying Netflix a $2.8 billion breakup fee to get them to go away, and now this fight. So it's pretty obvious David Ellison really wants this deal to happen, and he's going to work as hard as he can to make it so.
Absolutely. Well, it's going to be fun to figure out where exactly it goes from here. I know you'll be tracking it very closely with your team. That is Bloomberg's Chris Palmieri joining us on the latest with that Warner Brothers Paramount deal saga. Meanwhile, you take a quick look at what's going on in the broader indexes on this Monday afternoon. The S&P 500, it did dip into negative territory a little bit earlier today. The NASDAQ 100, Sally, looked like we were getting pretty close to erasing gains. Looks like we're going to finish in the green, but we know it's a consequential week for a lot of these big tech names.
That's right. I think the semiconductors, they had a bad week last week, but the week has opened with a little bit more belief in the AI infrastructure trade. Investors seem to be potentially buying some of the dip and are coming back in, and we've seen the Nasdaq rise a little bit in response to that.
Absolutely. But we're going to talk a little bit about how the market is positioned heading into a very hefty calendar coming up next with Amy Wu Silverman of RBC Capital. This is The Close on Bloomberg. Welcome back to The Close. I'm Katie Greifeld alongside Sally Bakewell, and we have less than 10 minutes to go until those closing bells. Here's the setup on your Monday afternoon. You can see the S&P 500 dipping into the red to start the week. We're coming off a week of losses for the index, and you can see that sentiment hasn't quite recovered today. The NASDAQ 100, though, where big tech lives, hanging on to its gains rate now, higher by just about 0.2%, well off of session highs, I will note. Meanwhile, Brent also caught in the crosshairs when it comes to what's going on the geopolitical landscape, at the level inching back up towards $90 a barrel, all as bonds sell off. 10-year Treasury yields higher by about 4 basis points, not exactly providing much of a cushion, much of a haven to what you see going on in the equity market right now. But let's get right to it with Amy Wu Silverman. She is head of derivative strategy over at RBC Capital Markets. Amy, it's great to see you.
Great to see you.
So it is a hefty calendar coming up when it comes to the tech names. And it's landing at a really interesting time, because you think about the conversation happening when it comes to the dynamic between the semiconductors and the hyperscalers. We've seen free cash flow estimates sort of flip-flop for the two. And we've also seen a lot of worries about what's going to happen if we see any hint of these hyperscalers maybe thinking about pulling back on their Capex plans. When you take a look at how markets are positioned, how investors are sort of preparing for this week, what do you see?
So what I think is so interesting is, I know folks have called this just a generational transfer of free cash flow, if you will, but obviously the semis and the hyperscalers, they're inextricably linked. And so this weekend, I sort of said, well, the most important thing is what is the options market pricing for Google earnings? And I can tell you it's actually fairly sanguine. And I thought that was so interesting, because so much inflection would happen if there was any inkling of perhaps we'll take it back a notch. That's certainly not what's being priced into the skew. So we're not seeing an increase in hedging demand, for instance. In fact, when you look at normalized skew levels, so just that demand for hedging across all tenors, not just in 1 month, it's actually essentially close to the 1-year lows. I thought that was a really interesting tidbit, but on the other hand, obviously not too surprising given just how dramatic the multi-standard deviation drawdown was. You are seeing overall hedging picking up a little.
That's really interesting, especially when it comes to some of the specific movement around Google and Alphabet in particular. But you think about Alphabet, I mean, it's outperforming the rest of its Magnificent Seven peer group. I know that we're currently questioning whether or not that moniker is still relevant, but I mean, how do they stand apart from some of the positioning when it comes to those other Magnificent Seven names, which maybe aren't holding up as well as Alphabet in this environment?
So obviously the kind of the second layer of analysis we asked was, well, is this kind of just true for Alphabet, or is this true in general for the hyperscalers? I will say there is one kind of nuance in options now, because duration has become so shortened, because there's so many more folks trading 0-day to expiry, trading 1-week options. It is true that in general your signals really only happen kind of 1 week before earnings. So right now, when you look at the other hyperscalers, you also don't see a notable pickup in that bearish sentiment. So it is not just a Google thing. It is kind of a across the board, despite kind of, again, that inextricable relationship you have. But of course, to give the caveat, this could be not true, 1 week from now when we get closer to the other earnings that are going to happen. Obviously, this week and next week, we get a very, very hefty concentration overall of market cap being reported.
Now, Amy, I wanted to ask you about the recent anti-AI, anti-data center pushback that we're having. Now, if that begins to really dominate the political narrative, how do you expect that to show up in the options market? And are you already seeing clients kind of hedge for political or regulatory risk in big tech stocks?
Yeah, it's funny. I was sort of looking at the dates, and obviously, we're still in July, but October 27th, you have Israeli elections. And then shortly thereafter in November, you have US midterms. And right now, to answer your question, you don't see term structure, so essentially that kind of forward-looking volatility as in particular spiked due to those events. Again, just that nuance of we are just seeing shorter and shorter durations trading in general. However, when we have conversations with clients, and this literally happened last week, one client, we sit into the meeting, what's the first thing they ask about? The moratorium that Kathy Hochul placed on data centers in New York. And, it's a moratorium, it's not a ban. However, that anti-AI sentiment, whether it be you're at a commencement speech and the kids are booing, or even something as serious as attack on leaders in AI, you're starting to see this overall pickup. And I'm curious if it starts becoming an election issue, which obviously not only has policy implications, it has huge market implications if we do start to see that pickup in the term structure of options.
So earnings growth for the S&P 500 is fundamentally pretty strong right now. But given how much tech got punished last week, are strong numbers no longer enough? Do companies now need to provide kind of flawless guidance just to keep their stock prices flat?
I think that Google's going to be a good bogey for this. Right now, when you look at just the implied move for options, they're not that high, so they're kind of plus or minus 5.5%. You have an average realized move roughly around 4, but if you remember back to last quarter, there's actually a 10% move. So the kind of more recent quarters have larger magnitudes than your overall. And I would say that if you start to see, as we get a little bit closer to the really big pickup in that hedging, not only for Google, but in general post that for the other hyperscalers, then I would start to say your expectations are going to be reset.
And Amy, we have less than a minute left here, but I'm so curious to get your perspective on SpaceX and what's going on between the two big indexes. It's in the NASDAQ 100. It's not in the S&P 500. Have you seen any nuances when it comes to how those two indexes are being traded?
I was dying to talk about it last time and I wasn't able to, but now I can. So the one really big kind of meta-structure thing to remember is that if it's included in one and not the other, that volatility spread has a structural reason to remain bid. And that's not just true for SpaceX. If future IPOs, your Anthropics, your OpenAIs, go fast track into one and not the other, and you've got that delay, I think that there is a structural reason why that volatility spread also remains inflated.
All right, well, it'll be so fun to see what exactly develops here when it comes to some of those other mega IPOs, how they're treated by the benchmarks. Amy, really appreciate your time. That is Amy Wu Silverman. She is head of derivative strategy over at RBC Capital Markets, helping us to preview what's going to be a big week of tech earnings. And you take a look at how the markets are trading as we get closer here. The S&P 500, it is in the red. The NASDAQ 100 doing its best to stay in the green. We are moving closer and closer to the closing bell, all the while full market coverage with a global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld here alongside Sally Bakewell. She's in for Romaine Bostic and here to help take us through the closing bell. It's a global simulcast. We're joined now by Carol Masser and Tim Stanovic. And Carol, a bit of a heavy trade that developed just in the last few hours here.
Yeah, kind of interesting. Are you being facetious?
No, not at all.
All right, well, I don't know. I mean, the S&P, I'm just going to go there. Little change. At one point, it was pretty much unchanged. But if you go inside the index, which we like to do, you actually have most names, about 331 to the downside. So there is definitely more of a risk-off trade today.
More of a risk-off trade, but oil moving ever so slightly higher. I think some folks out there surprised it's not moving higher on the day today, given the conflict in the Middle East and what many would argue escalating. WTI up above 83 a barrel. Brent close to $89 a barrel. We did see gas prices too tick up above $4 a gallon, according to AAA Sally earlier today.
And we also see the S&P 500 is up, helped by this bounce in chip makers after a slump last week that's likely prompted investors to be buying the dip. But Alphabet, Amazon, and Microsoft all helped prop up the index, though Apple and Tesla kept some of those gains in check.
Yeah, and of course, it does feel like we're in a little bit of wait-and-see mode. We know that we have a very heavy calendar when it comes to tech earnings this week, and not to mention a Fed meeting next week. But I'm getting ahead of myself because you take a look at where we're going to finish up on this Monday, just about 12 seconds away from those closing bells. The S&P 500 will finish about 0.2% lower. We did open in the green earlier today, but drifting lower into the close. The NASDAQ looks like it's going to close in the red as well as those official numbers settle here. And then the Dow Jones Industrial Average, if you put any stock in that, it's going to finish about 0.6% lower.
The Dow says thank you for mentioning me, Katie. All right, S&P 500, back there we go. Again, as I said earlier, most of the names in the S&P 500, Katie, lowered today. 337 to the downside, 165 gaining ground, one unchanged here.
Same story when you take a look at the sector level as measured by our friend the Circle here. Communication services did manage to finish in the green. So did information technology and energy. Those were your three lone gainers today on the sector level. 8 sectors finishing in negative territory. Your biggest loser on the day, healthcare, down by more than 1%. Followed by materials and industrials, Carol.
All right, guys, let's go to some of the individual gainers, if I may. This one, a top gainer in the S&P 500 and NASDAQ 100, number 2 in the S&P, and number 1 gainer in the NASDAQ 100. We're talking about Lumentum Holdings, ticker is LITE. This one finishing the day with a gain of about 5% here. You might remember in early May, it kind of got on our radar. That's when it was announced it would be included in the NASDAQ 100. It's an optical and photonic technologies maker, so definitely an AI play. Barclays upgrading the maker of such to overweight from equal weight. Stock is up about 100% year to date, and despite that, Barclays analyst says it's still attractive following a recent pullback, making it a good buy. So they've got a price target of $1,000 on this stock, and you can see closing at about $765 and change. So that's about a 36% increase from the last price on Friday before this note came out. So some upward momentum certainly in that one. Let's go on over to Teradyne. Did see this one also being a top gainer in the S&P 500 and the NASDAQ 100 as well, up about 3.5% at its intraday high, almost a 9% move to the upside. But again, finishing just under 4% here. UBS raising the target on the semiconductor manufacturing company to 500 from 440, maintaining a buy rating. So that means quite a bump up from where the stock is now, $333.76 a share. Stock, too, is up about 75% year to date, so it's been on a tear. And then, did anybody go to the movies this weekend?
Oh, not me. I'd like to next weekend, though.
You better do it before the baby comes.
That's true.
You should bring the baby.
Yeah.
All right.
Headphones.
All right. So there was a big movie out, as we know. We're talking about Odyssey, Christopher Nolan's The Odyssey, and we did see movie theaters moving today. But some of it too had to do with AMC Entertainment. They came out. They reported strong adjusted EBITDA for the second quarter that beat the average analyst estimate. So this stock was up 26% year to date, but we did see some peers like Cinemark also higher, up about 5%. So I think it was probably more on the earnings. IMAX, which I know you guys are going to be talking to the CEO.
Just a few minutes.
Rich Gelfond, a little bit later on. That stock had a tougher time today. So I'm curious to see what he has to say, though, about people going
Thanks for the promo. I like this.
You're very well. We're just one big family.
That's so true.
I don't know. I didn't see
the Odyssey. You don't know if we're one big family?
I know we're not one big
Tim's
family.
on the fence.
I did not see the Odyssey, but I know how it ends. So
no spoilers.
Yeah, I will not give anything away. But let's just say the story's been around for quite some time. Let's start with some media stocks. Warner Brothers Discovery and Paramount Skydance both fell today. This after a federal judge temporarily paused Paramount Skydance's takeover of Warner Brothers Discovery, saying it likely violates antitrust law. Warner Brothers Discovery fell by 3.8%. Paramount Skydance fell by a little over 2%. The judge did order that the companies hold off on consummating the deal for 14 days, scheduled an August 3rd hearing on whether to extend the hold for longer. Just a reminder that California and 11 other states sued to block the merger. They alleged that it would harm competition for film and cable TV distribution. All right, so Paramount Skydance and Warner Brothers Discovery lower. Warner closing at its lowest level going back to December 4th. Let's go to another media stock. This one, Netflix. Shares of Netflix fell today, down by about 2%. This was actually before all the Warner Brothers Discovery, Paramount Skydance stuff crossed. Analysts cutting their price targets for Netflix since the company reported earnings. That was last Thursday. Shares of Netflix are down by about 50% from those June highs of 2025. Since the latest report last week, 27 analysts cut price targets by an average of 19%. We recall Friday, shares fell by 7%. That was after the company forecast a second consecutive quarter of slowing sales growth that contributed to investor anxiety about the future of Netflix. And finally, Sweetgreen. SG is the ticker. Shares of Sweetgreen today fell by more than 6%. They were down as much as 9% earlier in the session, Katie. The slide saw the stock down last Monday through Thursday, 15%. It was a concern over the outbreak of that diarrhea-causing parasite linked to fresh produce. The concern that analysts have would that consumers would avoid the salad chain. Sweetgreen shares fell 26% in that 4-day period because I included Friday in there. Then they rose on Friday 14% because of where it was linked, and now there are questions about what it's linked to.
Right.
So who knows? An analyst over at Citi says that concerns that Sweetgreen will face incremental sourcing and prep costs, and consumers will avoid produce-heavy food during this current outbreak. Once again, Sweetgreen shares down by about 6%.
Yeah, you also saw Chipotle shares down again today. And even if it's not linked to some of the specific lettuce at some of these chains, as Tim was saying, just sort of the guilty by association, I think, is sending shares lower. Let's talk about the bond market, though, because there's no diarrhea-causing parasites there. Just a sell-off, a run-of-the-mill sell-off across the curve here. We know that oil prices were higher on the day. That led to yields being boosted across the curve by about 3 to 4 basis points here. The 10-year Treasury yield trading just below 460, Carol.
All right, so who watched the World Cup final?
So
Show hands, everybody.
Well,
come on.
I was driving, but so I didn't.
Did you listen?
Yeah, I listened to the whole thing. And my son watched it, the whole thing on my phone in the back seat. I don't know what kind of dad that makes me.
No, good dad.
In the back, and I would have to have him
He wasn't driving the
explain.
car, so it's fine that he was using the phone.
Yeah.
Well, there's an estimate out there by NDTV and saying that the FIFA World Cup may have cost the U.S. economy $11.7 billion in terms of lost productivity. Globally, the tournament may have led to a loss of $17 billion in productivity.
Well, think about it. Think about it globally. I mean, 1.7 billion people around the world tuned in. And here in the U.S., Sally, it was nice because we finally get to host it and have it on our time zone. But you had people all over the world staying up in the middle of the night to watch this thing on a Sunday or getting up really early Monday morning. They're not going to be so productive at work after that.
You know what I was thinking? We have the UK is out of the World Cup, but we have a new Prime Minister in. I did not watch the final, but I did see the England-France game. And while that was just for third place, it was a phenomenal game with a lot of discussion around the time that if only England had brought that sort of pace and spirit to the Argentina game, they might have done a little bit better, but it shows the difference pressure can make, which also feels a bit like a financial market analogy there somewhere.
There you go, yeah. And there were a lot of goals scored in that third place game. I know nothing about soccer, but I know that the score was higher than usual.
No, in the third place game there were goals.
Yeah, in the third place game.
Yeah, the Saturday
the third place game.
Yeah, 6-4 was the final
That's so
score.
many.
Yesterday's went really slow.
Yeah, well, I was also driving, so I missed it.
All right. Okay. Well, that's
And
a
it
wrap.
was in New Jersey.
I know.
Both of you
skirted by it pretty much.
Yeah.
I went to the Home Depot in Jersey City, Carol. I didn't see you there.
Oh, man, I almost did
I think
go.
we have to
That
go.
would have been so funny. All right, next time.
time.
Just call me. Katie, call me. I'll
There
meet
you
you,
go.
I'll meet you in plants.
I'll just start
Up
shouting.
on the roof. Okay, deal. That is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it The Closing Bell. Sally and Katie continuing there, of course, on The Close on television. Be sure to check out their upcoming interview with the CEO of IMAX, excuse me. I want to get that right. And they're going to talk a little bit about the movies. We are back here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And coming up, as Carol mentioned, Christopher Nolan's The Odyssey posting an epic debut. IMAX CEO Richard Gelfond here to discuss the film's blockbuster performance next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Sally Bakewell. Let's take a look at where markets closed out the day. The S&P 500 closed down just a touch. It was initially helped by a bounce in chip makers after a slump last week that's likely prompted investors to start buying the dip. The Nasdaq, that closed up just a little touch too. The sentiment has similarly helped it climb, also led by semiconductor companies after it had its worst week in almost a month. Investors are piling back into the semiconductor heavyweights like Nvidia and Intel in anticipation earnings reports that will serve as a critical stress test to see if big tech's profit margins are matching their AI infrastructure investments. And then, of course, we had the Philadelphia Stock Exchange Semiconductor Index, which also gained after falling into a bear market Friday, as investors indeed bought back into that AI infrastructure trade. And then lastly, oil. It has swung sharply between gains and losses today as traders grappled with a flurry of headlines around the Middle East conflict, including targeting of vessels attempting to transit the Strait of Hormuz.
All right, let's take a look at some of the day's biggest movers on the equity side. We've been talking about it all show, but a big move from Alphabet, reportedly developing their own server chips for their Gemini model. Shares higher by about 1.5% on the day. Warner Brothers Discovery, as discussed, their deal with Paramount running into some snags, halted for the time being. Shares finishing about 4% lower. And Chipotle, as we were just discussing with our radio friends, that parasite fears continuing to echo through the salad stocks. Chipotle shares down 3.8%. But let's get to our top story this hour. It's one of the year's most anticipated films delivering big time in the box office. Christopher Nolan's The Odyssey, the #1 film in the U.S. and Canada in its debut weekend, posting nearly $125 million in ticket sales. Now, a large portion of the weekend's box office performance generated from screenings in IMAX's giant auditoriums, many of which were sold out months in advance. Let's discuss with Richard Gelfond. He is the CEO of IMAX, joining us on set. Rich, it's great to see you.
It's great to be here. Thank you.
So I want to start there. You know, you think about the large auditoriums. That's where people want to see The Odyssey. It's very hard to do. I mean, there's been viral social media posts that even if you want to see a 2 a.m., a 3 a.m. screening, it's sold out. You can't get in. So, I mean, is there a plan to expand this to more theaters, more auditoriums around the world?
So I've got to divide it into pieces. One is there's lots of availability in IMAX globally, and we have about 2,000 screens. A subset of that is film screens, because Chris Nolan was the first director to ever film an entire movie with IMAX cameras. So if you want to see it captured in IMAX film, projected in film, you can only do that at the film theaters. Our network overall has done very well. It was a record opening for us. We did $52 million on a like-for-like basis, the highest we've ever had. And in fact, it was almost 50% above Oppenheimer, which, you know, went on to be a huge success.
Right.
So the question is about, there are lots of IMAX digital theaters. The film ones are rare. In a way, though, those theaters are like the Rolls Royce. And the economics around them are very high end. You have to put them in a very big auditorium with a very big specialty made screen. Film prints are $50,000 for one print at one theater. So you have to get tremendous amounts of capacity. So fortunately, in the places it's worked very well. So at the TCL in LA, we did $500,000 in one day in one screen, which is an incredible number. And as you said in your intro, people are flying places. So the economic model doesn't really work to put IMAX film on every corner, but fortunately there are a lot of digital theaters, so people can go to those.
Absolutely. So I hear what you're saying there, but I mean, knowing what you know now about, what a hit this has turned out to be, what demand has looked like, I mean, in the run-up, would you have planned anything differently about this rollout?
Well, for Oppenheimer, we only had 30 film theaters, and we have 40% more for this one. We knew it was going to be very big, partly because it was the first film shot completely with IMAX cameras. We invented a new camera in order for Chris to make this film, partly because we know Chris, and conquering a story like the Odyssey, he thinks big, and we are big in a lot of ways. So we knew there's not really much we could have done. We kind of scoured the world to try and find film projectors, and we added shows in almost every theater. So we added, in 42 theaters, we added shows between midnight and 3 a.m. I mean, the 6 a.m.s were sold out. In London at the BFI, we've already sold out a large number of shows in weeks 7 and 8. So just stop and think about that now, 2 months from now. So we were prepared, but there's not more we could have done, really.
So thinking about the bigger picture, IMAX expects that 2026 will be its best year ever at the global box office, with some 1.4 billion projected. How will you hit that number? How much do you need the sort of big Hollywood hits to carry the load compared to the local language international blockbusters?
So we're a portfolio of films. Last year we did 1.2 billion. In the first half of the year this year, we did about 600 million. And then you go fast forward to the second half. So you have Odyssey, which is going to be one of our biggest movies of all time. We've got in select locations Spider-Man. We have Dune 3, which was filmed with IMAX cameras also by Denis Villeneuve, and that's around Christmas, and tickets have already sold out for that. We have Avengers in certain territories, a new Tom Cruise movie, so we think that goal is attainable.
Another more general question. In May, there were reports that IMAX was exploring a sale and has approached entertainment companies as potential buyers. What would be the rationale for doing that, and are you able to give us any updates on such a process?
Well, we've said many times that when we sign a contract, we'll let everybody know. So it's our corporate policy not to comment on these kind of rumors. And with all the turnover in the media space and the M&A activity, it's not surprising that that rumor would be out there. But we'll let you know if it happens.
Yeah, please do. Ideally, right here on this set with this show.
Should I put you on speed dial on my cell phone?
That would be great. Just put us on speakerphone in the room where it happens. But getting back to sort of the movie theater biz, you did mention that this is the Odyssey, the first movie to be filmed entirely with IMAX cameras here. You've seen other films partly filmed with your cameras. Do you think that, and have you seen any more directors being more encouraged to shoot either primarily or entirely with IMAX cameras, given the success that we've seen with Christopher Nolan and with the Odyssey?
So this year, we released 12 films that were shot with IMAX cameras. What makes this different is it was shot with a new film camera that we invented with the Nolans specifically for this project. So that took a significant amount of resources, both capital and human capital, and we invented something called a blimp. IMAX cameras traditionally are noisy because the film spools are huge. But the blimp takes away all external noise, so it allows you to do close-ups where the actors aren't acting in front of a refrigerator. It's very quiet. So it opens up a whole new avenue for us. But digital cameras, which we've used for a long time, many pictures this year were filmed with digital cameras, including The Mandalorian used digital cameras. And Hail Mary was captured with digital cameras, but released on film, and we've done that for years. But I do think this will create more demand, and as we look forward to 2027, I think there'll probably be 5 or more films released on film.
All right, Rich, that's a good place to leave it. Always great to see you. That is Richard Gelfond. He is the CEO of IMAX. Now, coming up, we're going to shift gears because we're tracking Boeing's flight path after CEO Kelly Ortberg's upbeat commentary at the Farnborough Air Show. We'll assess the outlook next. This is The Close on Bloomberg.
Take a look at shares of Boeing, closing lower, down about 2% after Chief Executive Officer Kelly Ortberg said the aircraft maker is close to turning the corner on its production schedule. The CEO of the aircraft maker sat down with Bloomberg's Guy Johnson at the Farnborough Air Show in the UK to discuss the company's roadmap and much more. Take a listen.
We're turning the corner. I tell my team we haven't quite finished turning the corner. We've got more work to do, but I am pleased with the progress so far. We're ramping up production across many of our product lines. Markets are very strong, so our backlog is very, very strong. So our story is really focusing on executing that backlog.
Okay. The administration, the White House, has given you massive support over the last 18 months. The President certainly had your back. Do you think the company would be where it is now, that kind of progress that you've made, without that kind of support?
Well, I think the execution focus is really on us to go improve our overall performance, build trust with our stakeholders, restore trust with the regulator. And I think that's more what Boeing has done for themselves. The President has been very helpful in sales campaigns. Balancing trade, the best way to do that is buy a bunch of airplanes. And so we've been a beneficiary of that. He's been very helpful to the whole aerospace industry.
So you're in a good place right now.
Yes.
So what's now?
Well, we still have to ramp up higher. So we're at 47 a month now on the 737. We have aspirations to get to 63 a month rate. We're at 8 a month rate on the 787. We want to go to 10 later in the year and then higher next year. So we're investing in new capacity, new facilities so that we can continue this rate ramp. The backlog is there. The market is strong. So it's all about delivering more airplanes.
You say the backlog is there. The market is strong. You like the economy right now? The consumer looks good, particularly in the States. The consumer wants to fly. The airlines are certainly saying that. But you've got Brent this morning at $90 a barrel. You've got the ongoing conflict with Iran. Kind of just give me your flavor of what you're seeing in front of you in terms of what the macro picture looks like.
It's a super resilient market, and while we always see perturbations here or there, regional perturbations, which we're seeing now, we forecast that the market's going to continue to be strong. Traffic continues to grow. We just came out with the new forecast for overall aircraft growth, and we see 44,000 airplanes in the next 20 years. So this isn't a market that moves quickly, because you have to make orders for aircraft well in advance, and we think that the demand is set for our aircraft going forward.
And our thanks again to Boeing CEO Kelly Ortberg, as well as Bloomberg's Guy Johnson. Really interesting conversation there as we think about how we wrapped up today's markets. A lot of focus on oil, which of course is a big focus for the entire air industry. You take a look at NYMEX crude trading at about $83 a barrel. When it comes to Brent, trading just below $90 a barrel. And we do have a headline coming from U.S. Central Command that forces began a new round of Iran strikes at 4 p.m. Eastern. We know that oil, Sally, really caught in the crosshairs of what is going on geopolitically. Maybe some optimism that we could see renewed peace talks, new truce talks here, but certainly the price continues to go higher.
Right. I mean, it must be tough for traders out there as it vacillates is the right word I was looking for, between gains and losses today, as you know, these headlines and the sort of lack of clarity around what the situation is regarding the Strait of Hormuz.
Right.
So yeah, I wonder how much the week will continue to see the same kind of volatility.
Yeah, we will continue to watch that as well as everything else, but we're going to talk FIFA up next, so don't go anywhere. This is The Close. The FIFA World Cup 2026 officially making its mark as the most lucrative sporting event in history. Our next guest has been tracking the spending surge, and we're going to get to them in a little bit, but let's actually first pivot here because, of course, our next guest has spent years on the field. He is pivoting his professional career to sports broadcasting and now finding the next generation of amateur players. Joining us live is Jozy Altidore. He is former forward for the U.S. men's national soccer team, now a soccer broadcaster over at Telemundo. Jozy, great to see you in person.
Thanks for having me.
So we're fresh off the final, of course, and I'm sure you haven't had enough time to reflect on the experience overall, but when you think about the past few weeks, the past month or so, would you consider this World Cup a success?
Oh, absolutely. By and large, I think when you look at the metrics, fan engagement, obviously viewership, it's easily, one of the best World Cups to date. And so for me as a former player, I was really excited to see, how the U.S. and Canada and Mexico were able to organize the event quite flawlessly. Obviously nothing's perfect, but overall, I thought it was really, really good. And then to have the kind of crescendo last night in New York, it was really special and ending to a great summer.
It was in New Jersey, let me just say that.
Very true.
As a New Jersey native.
Guilty.
It's okay, it's the same thing to the rest of the world here. But, we always talk about the halo effect that potentially a World Cup has on soccer in the U.S. when you think about the U.S. team moving through the rounds. And you think about the World Cup being held in North America. What do you think that success looks like for MLS now that, sadly the World Cup is over?
Yeah, I think the biggest thing to focus on is like the last time we had this World Cup in '94, there was no professional league to fall back on. So consumers, new fans, they had nowhere to go to put all that energy. And now fast forward, 32 years and we have a domestic league that literally kicks off, this week with 15 to 30 games over the weekend. We have the Leagues Cup starting, which is a competition between MLS and Liga MX. So there's a ton of opportunity now for fans to kind of go and continue that excitement, continue that fandom, and hopefully continue to kind of bring soccer to the forefront.
Got to ask you about those controversial hydration breaks. So what do you think of them? Are they here to stay? FIFA claims it's for player welfare in the summer heat, but there were some criticisms that it was about, introducing new ad slots.
Yeah, I'm not going to lie, I wasn't a fan. Look, I think there's obviously two sides to that. I think the first side is when you're playing in extreme temperatures, I think it's everybody's best interest to make sure they're hydrated, everything's, the health and wellness of the players are number one. But in some cases in this tournament, we saw really no need for a break, right? The weather was fine. Some of the stadiums were indoor. So it kind of took a little bit of the life out of the game. And I think soccer is still a purist sport. So you want to see it be played as closely as possible to as designed. So depending on weather, I'm okay with it. But for the most part, we should probably keep it out of the game.
When I was growing up, it was all about the halftime oranges.
Yes.
I don't know if they still do those. So, of course, while the tournament was deemed a success, including financially, was it a bit distracting, or how distracting is it for players to have the kinds of political incidents and distractions that we saw this time? For example, with President Donald Trump's intervention with the one-match ban for Folarin Balogun.
Yeah, what happened with Balogun was a bit unfortunate in the sense of, everything that kind of happened around it, because I think it affected kind of how the team had to approach that game. I think it affected how Belgium then had to approach us. I think it gave them a little bit of extra fire. And so I understand the intention. I think it wasn't a red card, but I think the manner in which they arrived at that was pretty controversial, and for good reason. So that part wasn't great. But beyond that, was really proud of the team, really proud of how they competed, how they represented themselves, soccer in this country. And the viewership tells a story about, people's intrigue and excitement about where the sport is today.
Yeah, absolutely. And I do wonder, you think about the number of teams. We had the most ever this year, I believe. Do you think that the tournament should expand to 64 teams from here?
I think it's interesting. I think it's definitely worth exploring. I think the details here are the most important thing, because I think what made this World Cup so good is that the games were of quality, right? Everybody kind of felt like they were representing their countries, watching them being represented, but also feeling like the games were competitive. So I think that's something that you just have to, be mindful of and make sure that if you do add teams, you're adding them in a way where competition stays high and that intrigue is still high. And I think that's what you have always in a World Cup. So you got to be careful with adding, more twists and turns.
All right, Jozy, well, really cool to talk to you. Appreciate you stopping by after a very busy weekend. That is Jozy Altidore. He is former forward for the U.S. men's national soccer team, now a soccer broadcaster at Telemundo. Sticking with the World Cup, now we're going to talk about spending because our next guest has been tracking the spending surge as an executive at Visa, which of course is an official worldwide FIFA partner. Joining us live, I'm pleased to say, is Frank Cooper. He is Chief Marketing Officer over at Visa. So, Frank, give us the lay of the land here. Of course, you have a pretty unique view into what spending looked like around the World Cup. What are some of the figures that really stick out to you?
Well, first of all, great to be with you. The figures that stick out for me it starts with cross-border transactions. And what we're seeing in our spending data is a 16% year-over-year increase during the tournament. We're seeing some surprises. San Francisco, we've seen the largest of all the metro areas that hosted the game. San Francisco had the largest spending growth during the tournament, up 15%. We saw that visitors from the United Kingdom delivered the biggest jump. Some say it's the Scots when the Scots went into Boston. I think it's more than that. They're seeing a 50% increase year over year. And then in terms of categories, we're seeing some surprises. Entertainment, not necessarily the biggest surprise, but entertainment is up 17%. That's the highest growth spending category during the tournament. And so it's the way we look at it. This 39-day experience that we're calling the World Cup is much like a pop-up economy,
right?
Where we're seeing small businesses grow and across restaurants and entertainment.
Yeah, I really like that framing, a pop-up economy, if you will. You mentioned the United Kingdom visitors coming from there when it comes to the biggest spending jump. I do want to talk a little bit about Norway because I'm looking through your stats, and it looks like Norway went absolutely crazy when you take a look at the transaction volumes. What's going on?
What's fascinating to me is that, and this is one of the things I loved about this particular tournament. There were these great stories that came out, new heroes. So the rowing effect from Norway or Erling Haaland, and that got amplified on social media, and that we felt created this flywheel within the fan ecosystem. So we saw during the matches a transaction volume increase in Norway of 172%. So in Norway, 172%. But it wasn't just Norway. They captured the imagination of many different countries. Across 60 countries worldwide, we saw substantial increases in spending when Norway was playing. And I think for me, what was fascinating about this particular World Cup is that it wasn't just about the live broadcast. When you looked at what happened outside of the broadcast, that's where the fandom really kicked in. Whether it was the TikTok highlights or creator reactions or communities kind of sharing information, that's where it got really interesting, and that's where new heroes started to pop up, whether it's the goalie for Cape Verde or it's Erling Haaland from Norway.
And of course, Visa's data really shows, how consumers are prioritizing things like travel, spending, and engagement. I mean, what are your big takeaways in terms of what fans are prioritizing when it comes to experiences, especially in this economy, which does have a number of pressures on it right now in terms of inflation and interest rates remaining somewhat high?
Yeah, all bets seem to be off when it comes to the World Cup. People will spend what it takes to get to the game or to get to a watch party or to join family. And, what we've seen, though, those who decide to travel and to be physically located, they want to experience the host country. And, whether that's going to a Waffle House or picking up ranch dressing, they want to experience the host country. And the heart of each host country and host city will be the small businesses. And so we saw substantial increases in local restaurants. We saw substantial increases in local vendors. And, that's what we're seeing as a big shift. Experiences over things, and those experiences are expressed to the local communities.
Got it. Yeah, the ranch dressing was a topic of huge discussion around here. Visa, of course, also talks about how it helps fans connect with the World Cup. So talk us through your strategy there.
I think one of the biggest shifts that we've seen in the past 10 years or so in fandom overall is that it's no longer just about capturing the attention of the fan during the live broadcast. As I mentioned earlier, much of the interest among fans happens outside of the live broadcast. And so rather than renting attention, we're trying to build community. And so we're building that community around this idea of tapping in and giving people access and participation. So we created this campaign called the Tap In campaign, and it's a play on words. You have the tap in goal, which seems like the easy goal with no friction, et cetera, but giving people easy access to the things that matter to them. And so great ad with Jason Sudeikis and Erling Haaland and Lamine Yamal and Jorge Campos. And but the core idea is that you can tap into tickets. We did pre-sale of 1 million tickets plus. You can tap into kind of VIP access. You can tap into travel. We gave away, special jackets, FIFA World Cup jackets, signed memorabilia, and for us, it was less about just a collection of rewards. It's the things that people told us that they really wanted, number one, but also number two, building this community and extending the community around it and pulling the data around that, so that when this is all over, we're not just left with renting attention. We're becoming a critical part of the community of this fan base.
Right. That's kind of where I wanted to go, Frank. I mean, now that we have closed the books on the World Cup 2026, we have 4 long years to wait. How do you use and take what you've learned and sort of keep the momentum going over at Visa?
So the way we look at it is that we have FIFA Women's World Cup coming into next year in Brazil. And I mentioned Jason Sudeikis earlier. He plays Ted Lasso on TV. The next season of Ted Lasso will focus on women's football. So we're really fortunate to tap into that. So we think we can actually have some continuity from Men's World Cup here in North America to Women's World Cup in Brazil. But also, even when we go into LA 28, we're also sponsors of the Olympics. And so this idea of fans wanting to be connected to players, wanting to be connected to creators, we think we can extend that across these platforms. So again, we're not renting attention in a case-by-case basis. We're actually building Visa within those individual communities and carrying them across these platforms.
All right, Frank, really appreciate your time. That is Frank Cooper. He is Chief Marketing Officer over at Visa. Now, coming up, a slew of big tech reports on deck. We'll break it all down with Erica Brescia. She is Managing Director of Redpoint Ventures. She joins us next. This is The Close on Bloomberg. Well, we have a big week ahead for tech results. Alphabet, Tesla, IBM, and Intel all on the docket. Let's break it all down with Erica Brescia. She is Managing Director of Redpoint Ventures. She joins us now. So, Erica, you think about what we're going to hear, especially when it comes from the chip makers, the hyperscalers. It lands at a really interesting moments for markets and for the tech trade. There's a lot of nervousness, a lot of volatility that has started to be priced in over the past few weeks. And I wonder, when we start to hear, especially from some of the companies that have been doing the heaviest spend when it comes to Capex, do you think that has the potential to maybe put some of these jitters to bed for now?
I sure hope so. I think a lot of people are still reflecting on the infrastructure build out during the days of the internet, and there are concerns about overbuilding. I think those concerns are unwarranted. If you look across the board, the inference providers are constantly fighting for and running out of GPUs. As much supply as we can bring online, people are just absolutely gobbling up. And so, we always want to learn from the past, but there's certainly no evidence that that particular story is going to repeat itself with all of the advancements in AI.
Well, we were having the conversation with Matt Rowe at the start of our show of Man Group, and he made the point that the AI that we're using today, it's probably going to be the worst AI that we use in our lifetimes, because you think about how progress marches on and accelerates. And from that perspective, you think about all the money that's being funneled into it. Is it possible that maybe we are seeing some sort of overbuild at some point in that supply chain?
I mean, you could always look at a particular point in time and maybe one piece of the puzzle gets a little bit ahead of others. But I don't think that there's a huge macro issue here from what we've seen. I've said this before, I'll say it again. We're still in the very early innings of AI and understanding how to use it and really put it to work and squeeze the value out of it in the enterprise. The first step was just building models that are functional. Now there's a lot of work going into inference and how do we deliver models as efficiently as possible? How do we route requests to the right models so you're not, using a Ferrari for something that a Toyota could do? There's all of this work that still needs to happen to really put AI into production in the enterprise. And as that continues to progress, I actually think we're going to see more and more demand. And yes, it will get more efficient to do the work, but there's going to be more applications, more use cases for AI. And so I think that we'll just continue to gobble up all of the supply that's coming online. And, it's important to note that most of these inference providers are booking out years in advance. You have to book GPU capacity out into 2028 right now. And so, we're still trying to play catch up as opposed to being in an overbuild situation.
And so, Erica, what's your prediction? Are you expecting that Alphabet will signal more investment in AI? And you expecting to see revenue accelerate? And what do you think the market will take away from that if we do see Alphabet saying so?
Well, I don't know what's going to happen with Alphabet. I sure hope that's the case because I think it will have a positive impact on the markets more broadly. I think people are going to be looking for how the infrastructure that Google has today is converting into revenue, how they're seeing usage increase. I think there is an impatience for, actually deriving revenue and growing businesses around all of this Capex spend. And so people are going to be keeping an eagle eye on those numbers. I think they're also going to be really trying to tease apart, a lot of the time we'll see EPS go up because of the holdings that Google or Alphabet has in companies like Starlink and Anthropic, of course. And I think there's a lot more attention going into not just EPS, but like where is that growth coming from and what's moving the needle? And if there's not a really strong AI consumption story there, then I think we'll see investors sour on the stock.
Gotcha. And when it comes to Intel, of course, this has become one of the most closely watched AI infrastructure stories after its rally. I mean, what are the key line items that you are going to be focusing on?
I think people are really, they're still in this period of trying to rebuild trust. And so they're going to be looking at the performance of these new chips that they're bringing online, trying to understand if they're making the month-over-month progress in efficacy that they're looking for across the chips.
And you think about Intel and sort of the unique story it's had when it comes to its AI turnaround, the involvement of the U.S. government, et cetera, et cetera. I mean, when we get these Intel results, is there anything that we can extrapolate to the rest of the chip makers, or does Intel have an idiosyncratic story?
I do think they have an idiosyncratic story. I think the markets are looking for other strong U.S. players in the chip space. Intel, again, had a lot of trust to be rebuilt over, a period of underperformance and not meeting commitments and expectations. I think they seem to be making very fantastic progress there, which is what has delivered the stock performance to date. But that's going to need to continue. And if there's even the slightest amount of faltering, I think we'll see a big slip back in the stock.
Absolutely. Intel shares currently higher by about 163% on a total return basis year to date. So certainly the stakes are high. Erica, great to preview some of the action with you. That is Erica Brescia. She is a managing director over at Redpoint Ventures. This is The Close on Bloomberg. Let's take a quick look at how markets closed out on the day on this Monday. A tepid start to the week. You can see the S&P 500 down about 0.2%. Big tech holding in there, though, the NASDAQ 100, that's pretty much unchanged. You did see a sell-off in the bond market as we continued to see energy prices bounce around, Brent crude higher by about 1%. And let's go back to tech, though, because, Sally, we were looking at this chart at the beginning of the show here. When you think about the free cash flow handoff between semiconductors and hyperscalers, as you can see here, it's really sort of the question mark heading into this earnings season.
Yeah, that is right. I think, chip makers have been the focus of all of the major sort of the particular earnings discussions over the past couple of weeks. And so it will be interesting to see how that debate about,
Right.
whether the Capex is going to be justified materializes this week.
Absolutely, of course. That's been the question. It will continue to be the question, and we're going to continue to ask it and hopefully answer it here on The Close. But that does it for us. Balance of Power is up next. Have a great evening. This is Bloomberg.